So I see this also again, like, great, I'm going to save an extra $1,000 this year. Yeah, but not only is it more documentation this year, it's more documentation for the next 2, 3, 4, 5 years with that vehicle. Today's question has to do with buying trucks and whether you a work truck and whether you should do that in an LLC or your own name. So the question is it better to buy the truck under an LLC and get its tax deductions, or better to buy it personally and just pay for the commercial auto policy? Background, we own a cidery. We use the pickup truck for transporting stuff to and from the farm, to and from bars. This is not a full-time income yet. What would benefit us more from a savings and a tax footprint standpoint? Well, this is a question I get all the time, and at some point, it's a very simple answer. It doesn't matter who owns the vehicle. It matters how you document it ultimately. You could do it either way and still take the full business deductions. Now, when it comes to vehicles, there's two standard ways, two normal or two allowed ways to do deductions for the business use. There's the standard rate, often called the mileage method. And it's very simple. You count up the number of miles you use for the car for business. And in 2025, you take a 70-cent deduction per mile driven. Now that this covers almost everything. If you do this, you don't get to deduct gas, repairs, depreciation, insurance, titling fees, etc. You can still potentially write off the business or the interest, and you can still write off things like tolls and parking, things that have nothing to do directly with the vehicle itself. This is a much simpler bookkeeping method. It is almost always a better method for cheaper vehicles, older vehicles, part-time use vehicles, and can be downright profitable with an electric vehicle where your cost of driving the car is way less than 70 cents a mile. Your other option is the actual expense method. You deduct your actual costs of everything: fuel, maintenance, insurance, gas, depreciation, registration. Anything having to do with the car, you get to deduct the actual expenses of the car. This can include depreciation for new or heavy vehicles, and in some cases, you can deduct 100% of the price of the vehicle in year one. I don't love that people try to buy cars just for that benefit, but if you're already buying a new vehicle, it can be a great way to do it. You can only do depreciation if at least 50% of the miles on the car are for business use. And if you depreciate it and then in a later year you don't use it for at least 50% of the mileage, you may have to pay back some of that deduction. The big downside to this method is it requires really good records on anything, particularly if you have a mixed use vehicle, a vehicle that you do some personal driving and some business driving on. You need impeccable records on this, on all of your driving, where you went, why you went, what was the mileage, because this is something that the IRS does pay close attention to. It's not a red flag, but if there's an audit, if there's a question, this is going to be one of the things you're going to ask for information about. This can be particularly beneficial with a new and expensive vehicle, particularly, again, when that vehicle is almost entirely or is entirely business used. It can also be very good in a year where you have a windfall. If you just made a ton of extra money this year and you're not going to in the future, getting that depreciation now can make a big deal. Now, again, you have to keep track of your business use percentage if you're using it for personal uses as well. Now, if it's 100% business use, it's much, much cheaper. But if it's mixed use, whether it's a daily driver or whether just, you use it to take stuff to the dump from your home, you can only deduct the percentage of business miles. Technically, it is sufficient to be able to document just your business miles. It is better if you can document your business miles and your personal miles. And it is a very good idea if you have any sort of a business vehicle to take a photo of the odometer every January 1st or December 31st. So you have some sort of proof as to what the mileage was at the beginning or the end of the year, because that's something we actually do put on the tax forms as well. Again, do not play games with this. if there is ever an audit on this sort of a thing, the IRS is completely brutal on any sort of a mixed use vehicle. They love to disallow some of the mileage. They love to disallow some of the expenses. And if they can show that your business use was less than 50% and you lose that depreciation, it can be a big penalty. Now, should you own it personally through the LLC? Again, tax-wise, it mostly doesn't matter because generally you can do it either way, particularly for the mileage portion. It's cleaner if you're going to do depreciation to own it through the LLC. There's other benefits to the LLC ownership. It's just much cleaner. There is potentially some liability protection, especially you talk about, if you have employees driving the vehicle, I would definitely have it in the LLC. It just makes it much more obviously a business asset. The downsides is it's more formality, and especially if you need to get a note to buy the vehicle, it can sometimes be more expensive to have the LLC buy it, and you'll still need to co-sign it. Now, with personal ownership, especially for doing mileage, it's way simpler. If you're only doing 20 or 30% of your driving, it's far better to personally own it. And actually, you may or may not need a full-on commercial endorsement. For example, my particular auto policy does allow me to do some business as long as it's not a ride share in my vehicle. Now, it probably wouldn't apply in your case because it doesn't allow me to use the vehicle for transportation of products. But like if I'm just driving around, for example, driving to Jack's workshop or Nicole's workshop, I can use my personal vehicle for that, reimburse myself from my LLC, and it's tax deductible. So it mostly doesn't matter whose name is on the truck. It's about how it's used, how you document it, and you need to reimburse yourself from the LLC ideally. And again, it is a little cleaner if you want to do a write-off on the depreciation. I didn't mention it, but also a write-off on the interest can be cleaner if it's through the LLC. In this case, you mentioned you're not full-time yet. So I would say simpler is usually better. Even if the actual expense will save you a little bit of money, if it takes you 30 hours to document it to save, even $300, that's not a good use of your time. So for most people, I do recommend just doing the mileage method unless you're absolutely sure you're going to save a ton of money with the actual method. And then again, it really doesn't matter whether you own it or whether the LLC owns it. Do whatever is cheaper. If it is mostly, 90% or 100% used for the cider business, and especially if you're buying a new vehicle, I would absolutely buy it in the LLC just to have more options. Now, one other thing, you can go from mileage to actual expenses, but once you do actual expenses, you have to do that every single year for as long as you own the vehicle. So I see this also, again, like, great, I'm going to save an extra $1,000 this year. Yeah, but not only is it more documentation this year, it's more documentation for the next 2, 3, 4, 5 years with that vehicle. So that to me is penny wise and pound foolish. Final recommendations, if it's a business vehicle and only a business vehicle, put it in the LLC. If it's your daily driver and you also use it for the business, probably hold on to it yourself. If it's 50-50, do whatever's cheap.